Today, we will talk about impaired credit, what it is, how it works, how to assess it. Impaired credit refers to a deterioration in the perceived creditworthiness of an individual, a business, or other entity. This is typically reflected in a lower credit score for individuals and a lower credit rating for businesses and other entities. Would-be borrowers with impaired credit will find it harder to obtain loans and generally have to pay higher interest rates if they do. Impaired credit can be either a temporary and fixable condition or a warning sign that even greater financial distress may lie ahead. Impaired credit is usually the result of financial stress brought on by a change in circumstances, often an unforeseen one. For individuals, impaired credit may be the result of a job loss, a costly illness, a steep decline in asset values, or a multitude of other crises that can make it difficult for a person to keep up with their bills. For a company, impaired credit might be due to increased competition, a weak economy, supply chain issues, or bad management decisions, among other causes. Credit scores are the most common measure of creditworthiness for individuals. Credit scores range from 300 to 850 and consider factors such as payment history and amounts owed. A score below 580 is considered poor, while one between 580 and 669 is considered fair. Good scores begin at 670, very good ones at 740, and exceptional ones at 800. If an individual's credit score drops, it may be due to late payments or high credit utilization, but with effort and time, they can improve their credit score and no longer be labeled as credit impaired. Credit ratings agencies assign letter grades to businesses, governments, and other entities based on their creditworthiness. Higher grades indicate a higher likelihood of repaying debts. An entity that has dropped a number of letter grades could be considered to be credit impaired. Credit ratings agencies consider various financial and non-financial factors when assigning ratings, depending on the type of entity being rated. Credit repair refers to the steps a person, or third party working on their behalf, can take to remove inaccurate information from their credit report that is damaging to their credit score. Only inaccurate information can be removed from a credit report, while accurate information will remain until it drops off due to age, usually after 7 years. Here are 4 key takeaways. 1. Impaired credit refers to a deterioration in the creditworthiness of an individual, a business, or another entity. 2. Impaired credit will be reflected in a lower credit score for individuals or a lower credit rating for companies, governments, and other entities. 3. Would-be borrowers with impaired credit will find obtaining loans and other forms of credit more difficult and more costly. 4. Impaired credit can sometimes be fixed by addressing the factors that caused it in the first place. Hope this would help. Thanks for watching.